Hi everyone, welcome to YX Insights. This is Yimin. Today is May 16th, Friday, and we are going to go through SPY, QQQ, the bonds, oil prices, Bitcoin, Magnificent Seven stocks, and with the addition of gold and semiconductor ETF. So let's begin with the market pricing in Fed funds futures. This is the projection of what the market expects the Fed to act in the next 12 months. So currently, the market is nearly no chance of a June cut, more than 50% chance for a cut to happen in July, and then September, or November. So essentially, in the next 12 months, the market expects between 3 and 4 cuts. So this is actually pretty much on par with the FOMC projections earlier in the year, and essentially is really not is moving the interest rate towards the neutral rate, in which the economy is neither expansionary nor contractionary because of the interest rates. And that is meant to be about 100 basis points lower than where we are today. So the current pricing in the Fed funds does not imply recession. And of course, it doesn't think the Fed will hike at all as well, even with the tariff that have been implemented. And now just look at our overall signals. So the YXI Signals this week has been pretty much risk on, right? We have all of the risk assets essentially showing signal of 1, meaning the model strategy prefers to take position in them across SPY, QQQ, Bitcoin, and all of the Magnificent Seven stocks we cover with the signals. However, the model prefers to stay in cash for bond holdings. So we've been on the sideline for TLT for a while, and actually that strategy has really outperformed the buy and hold. We've dodged consecutive days of losses that would have occurred if you held on to bonds. So overall, this paints a long risk assets versus essentially neutral to in bonds environment. And that is very favorable to equities, to stockholders. So just looking at the liquidity from the Fed side, the liquidity was pretty favorable at the beginning of the year. As you can see that the red line is the Fed liquidity. We use the Fed balance sheet minus the general treasury account and the reverse repo volume. And we see that this overall liquidity moves up between January and April. And that had helped bond prices to rise and yields to fall, providing a more benign loose liquidity condition for bondholders. However, things started changing at the beginning of April. The Fed liquidity started dropping quite sharply from 6.3 trillion to 5.9 trillion. A lot of it is down to the Treasury General account moving up due to tax receipts and bond issuances in April. So, and it's stayed at this level more or less for the past few weeks. And we have seen that the contraction in the Fed liquidity has essentially helped bond yields to move higher, all else equal, in the past month. So, of course, a lot of that is also the market sentiment of being risk on, risk off, and currently being very risk on with people buying equities and shorting or being neutral in bonds. But generally speaking, the Fed liquidity is not helping bond yields to stay low at the moment. So now moving on to the live chart, SPY. We have seen just pretty much a straight up rally since the April 21st local bottom here, right? And we have moved decisively above the 200-day moving average, which is very bullish. And there has been some volume here from the previous dip buyers in February. And this region could see some resistance because just think about the investor psychology here. The people who bought in this region are now essentially break even after 2 months of drawdown, a very painful drawdown, in fact. And now they get a chance to get out at zero net loss. So we could be digesting some of the moves from the end of February here. But ultimately, I do think SPY's next destination before a major pullback should be the wave 3 target at 208 plus. And we may even break the all-time high again. And that would be a massive surprise to a lot of people, as people are getting increasingly more skeptical and bearish as the market rallies. But we've seen that time and time again. The market climbs a wall of worry, and it often moves much faster than people can psychologically adapt. And that's why we have the set of signals we produce daily to show the overall market sentiment. And that is there's an objective set of signals trained using machine learning without knowing the human emotions. And I'm just looking at the trend line here as we move towards the 610 region. What we see is that we have had this trend line from September 2024, which was tested twice, and then on the second retest, it broke down, and obviously we've had the crash. But now this trend line could serve as the next major resistance, which is just in between the 1.382 and 1.618 extension of wave 1. So I do expect this region broadly as the next resistance area, and we could see a pullback once we reach the all-time high, as investors remain skeptical about if the market really warrants the valuation, the all-time high, given the tariff impacts. And then looking at QQQ, you will see a similar trend line here, where it started from October 2024, and if you can extrapolate even a bit earlier, September 2024, tested twice, and on the third time it broke down. We had the crash, and now we're approaching this region again. QQQ has actually rallied faster than SPY in terms of relative positions. So we're actually nearly at the 1.382 extension already. So we're approaching this resistance band already. And again, in this general area between the 1.236 and 1.382, there was some initial volume from the buyers back in late February, early March, who got trapped. And now they're looking potentially to sell at break even and get out. So I do think QQQ is a bit closer to the resistance band, but that's only because of its relative outperformance. So now we're looking at the 30-year yield. I like to look at the 30-year yield rather than the bond first, because that's essentially how the TLT is almost a mirror image of where the yields should be. So looking at the 30-year, we tested this January and April high in the nearly around the 5%. We tested that band this week, and we are seeing a little bit of a retrace and potentially testing the upper bound of this downward channel here. What I think is that the move on the margin should be higher in the medium term. And if we think about yields, really is pricing in two main components, and there's also obviously more technical details around the bond pricing versus interest rate swaps and all that. But really, we're looking at in the front end, what are the investor expectations of Fed Reserve cuts in the next 12 months. And now I'm actually thinking potentially the Fed doesn't really want to cut this year, even though it says they could cut possibly twice or even 3 times at the beginning of the year. The reason is that the jobs market is still very robust, showing huge net jobs added, and is also still a relatively low unemployment rate of 4.2%. Right, the Fed's red line is around 4.7%. This is highlighted in the economic summaries in the FOMC meetings. So unless we rapidly approach that level, the Fed is not really incentivized to act. Thinking about the inflation story, we've only had the inflation reading that is the same level as something like 3.5 or 4 years ago, right? So the inflation has been very high, and it's taken a lot of effort to now finally get on track towards the Fed's target, and tariffs may even derail that. Right. So the Fed is thinking, well, the economy is actually quite good if you strip out the net exports. The labor market is pretty strong. The risk is still on the high side for the inflation. We really don't want to act and cut rates preemptively, and which could lead down to further hikes down the road rather than less cuts. Because if inflation resurges back, and the Fed yo-yos and it does the wrong thing, and it has to more than compensate the mistake from today. If inflation gets back down to 2%, and then we have something like a massive recession because of the tariffs and everything, the Fed can always cut 100 basis points at a time. The Fed is not really that rigid about the 25 basis point increments. So I think the Feds really want to just wait, watch, and act aggressively when something becomes very clear towards one direction or the other. So that means I'm really expecting bond yields in the 30-year yield to breach the 5% mark and move towards 5.5%, or even the high fives. Correspondingly, for TLT, I think we are going to test the 84 mark. And I think we are going to likely see below 80. It might not be today, tomorrow, but I think that's the trend the market is actually going. And the second thing that I didn't mention earlier, where the market is pricing, is investors, is the term premium. Term premium is the extra yield that investors demand from holding long duration bonds to compensate for the supply risk and default risk of the government. So what they are worried about is the government shows a lack of federal spending discipline, and it starts issuing loads of bonds to spur growth, and that could be a lot of bonds coming onto the market, not enough investors, private households or hedge funds, or even foreign buyers to pick them up. The solution, there's only one solution in my mind, which is for the Fed to stop the QT and actually start QE again, come in as the largest buyer and save the treasury market. And I believe they would do it when it comes to that point. They may say they don't want to do that, but I think when it comes to it, to ensure the financial health and financial orderliness of the system, I think they will definitely start QE at some point. Now let's take a look at gold. I think gold has been very interesting. I do think this is a double top. And I think right now it's not clear whether we are seeing an ABC move down, where C has pretty much matched the length of A already. So as you can see, that wave C is already at the 100 to 123% extension of wave A. So if this is the pattern that the market decides to move, we should be expecting a bounce from here. So this would be something like a broader A, B, C, or even another 5 waves rally of this. But what's not clear to me is that this is only one alternative right now. And I do suspect that we could see further downturn in gold, because it could be a 5-wave structure down, and it is way too early to tell. But I think there is a distinct possibility for more aggressive 5-wave down, which would put the immediate downside target to something like 280 to 285 in GLD. So it's not quite clear which path it is yet. So we have to be aware of both the possibilities and just watch where things are going. If we travel down here, then it's definitely the black path. And we could expect a wave 4 bounce, but ultimately a lower low. And moreover, after the 5 waves down, we should really expect 3 waves up and then another 5 waves down to complete the broadest ABC levels. For GDX is a very similar story. We have wave C at similar length to wave A, but not quite yet. So we're still short of the 100% extension of wave A, but we can actually get to, we could potentially see 5 waves down still. So I think right now I wouldn't take a position to either go long or further short. I would just wait for further signaling from here. Bitcoin is, I think, likely in the beginning of a wave 4 pullback. And I'm just looking at the levels here. It has stalled around the 104K mark. And if we just look at this as wave 1 versus wave 2, and we see that this wave 3 has essentially moved to the 161% extension of wave 1, and that's a very standard bullish wave 3 target in terms of Fibonacci levels for an impulsive 5 wave. And now I'm thinking, okay, so it could push further, sure, 107K or all the way to 110K. But I think this rally, the majority of the meat on the bone is kind of done, is behind us. And there is a greater likelihood we are going to see some pullback towards in the wave 4. But the thing is, the wave 4 can be quite variable in terms of depth. It could really be anywhere between 96K to 100K here. So that's the 0.236 to the 0.38 retrace of this entire wave 3. And that happens to be an area of heavy volume that's been accumulated in the downside move and upside move. And I do think that a lot of people will be dip buying here. And I have seen a lot of institutional interest, fund flows into IBIT, the BlackRock Bitcoin ETF. And I do think if we get below 100K, we will see a lot of dip buying. And ultimately, we should see wave 5 almost, if not surpassing the height of January high and the December high. And now I would like to talk about Coinbase as well. So Coinbase was hacked yesterday, but the key issue with the hacking is that no one lost their private keys. Cryptocurrencies weren't lost. So what is one hacked? The hackers have stolen personal email addresses, names, birthdays, as well as the government IDs that they've uploaded online. So the personal information. And this is very similar to when banks get hacked and get stolen a bunch of personal information. So it's not quite like a hack we've seen in other exchanges where money actually was lost, physically stolen, but there will be a lot of compensation damages for Coinbase. I think the estimate is something like 200 million to compensate for stolen funds through the phishing, because people have stolen your ID. They could be used it to trick you into logging into the phishing website and then sending the thing, whatever. So a lot of money will go towards that. And also they've established $20 million for finding, for incentives for finding the hackers. And very interestingly, this hack happened at a key Fibonacci level for the technical move, which is the 200% extension of wave one. And if you just think about psychologically here, the market had a huge rally because Coinbase was going to be added into the S&P 500. It pushed for one more day, and the negative news came, and people were taking profit, essentially. And if you just look at the volume here, there was a lot of people who bought back in January and got trapped. And this was a natural area of interest to offload at break even. And the news served the catalyst for a drawdown. And actually, we've seen Coinbase rallying back today at 7% on the day. Do I think we go wave 4 is done and we go from there and further higher for wave 5? It's potentially we didn't quite get a large retrace from that news, and actually, in fact, we've made a new high intraday today. Typically, wave 4 should really want to test this 0.236 to 3.382 retrace. So I do think there is room for further correction, a pullback down to the 240s or even 220s, and it could coincide with Bitcoin also moving in a wave 4 pullback. So that's kind of my near-term thought, but I do think we will reclaim 300 at least in this broader rally, and or potentially a new all-time highs again into the 360s. I would like to talk about oil. I should have mentioned it in the earlier section, but with oil, I think the path of least resistance should be down. Essentially, there are two reasons for this. One is fundamental. The world's economy is slowing this year, especially with China. And China is adapting more EVs than the street had expected. And therefore, there's less energy demand from crude oil. And overall, the demand side has been weakening this year. But on the other side, on the supply side, we have OPEC essentially agreeing to unfreeze the supply ceiling, and ramp up the capacity of production for the next 2 years. So we have demand weakening, but supply going up from the OPEC plus. We have potentially a truce between the US and Iran, which could lift the Iran sanctions. One caveat is that Iran has been operating with dark fleet exporting oil to China already. So how much more they can produce for the international markets, we don't know for sure. And similarly, Russia has been exporting a lot of oil into China. So if we get Ukraine-Russian truce as well, the US will uplift the sanctions, but how much more capacity for Russia to export is a question mark. But for sure, there will be more, which means it is incrementally adding more supply, and that should push the oil prices down. Similarly, outside of the OPEC countries, we have US and Canada ramping up production or making supply higher, and therefore energy prices lower. So that's on the fundamental side. And on the technical side, I do see this as a 5-wave down potential. And the reason I think this is a 5-wave down rather than an ABC correction is because the wave 3 here was quite stretched. Is moved to 138 extension of wave 1 from the height of wave 2. And I think this is wave 4. And we're now beginning wave 5. And wave 5 could take shape in the 5-wave level again. And so what I'm thinking is we have essentially this is the wave 1, and wave 2 is pretty much marginally lower than the start line, and wave 3 should really be anywhere in the 57 to 58, 59 region, and ultimately we can land in the sub 55s, and that's exactly what Trump wants, because he is trying to use lower food prices, lower energy prices to offset the price increases you will see from tariff impacts. The idea is to be net, to have those factors netting each other off, to reduce inflation, or at least keeping it broadly a similar level. So I do think a near-term trajectory is for oil to go down. Now let's look at Max 7s. So Apple has really struggled to get past this May 1st high. But I do think the broader direction should be moving upwards towards this wave 3 target at 230 plus. There is quite a lot of volume to get through overhead in this 220 region, the 200-day moving average, before we can land to here. So Apple has a lot of work to do, and it hasn't pushed past this wave 1 high. So it's not quite as bullish as, for example, SPY, QQQ, and other Max 7 stocks. Will we see a gap fill here? I mean, there is a potential that we fill this gap and then move up first. But my primary expectation is that we don't dip below this wave 2 low on the May 7th. So yeah, we can have a gap fill and then move further up. Amazon tapped the 1.382 extension of wave 1 and now is moving in wave 4. So I'm just going to highlight wave 4 retrace here, and it really could be anywhere between 188 and the 200 level, essentially. And that's basically the 0.28236 to the 0.5 retrace of this wave 3. I am leaning towards the upper side of this range, essentially around the 200 level. The reason being, this wave 2 pullback was very steep. And in terms of Elliott wave theory, there is a symmetrical expectation where if the wave alternate, it's called an alternating principle, where wave 2, if the wave 2 is deep, wave 4 tends to be shallow, and vice versa. So I do think we should hold above 195 in this, and ultimately we can get into 230s, for example, for wave 5, if not the new all-time high here. For Google, I think it's quite interesting. Google has now finally moved into this 100% extension of wave A, and that's right below the 200-day moving average. So for the longest time, I have been essentially insisting that we are still on the move up towards this green box, even though we had this dip, because that wave C felt incomplete. But now this wave C can be deemed completed, and we could expect a wave A, a wave B, and now wave C down towards the low 100 levels. So what could break my expectation? If Google gets decisively above this green box, get into 176, then I could be thinking maybe this is wave 1, wave 2, and then wave 3 up here. So until the price action has decisively moved above this 176 level, my primary view is that we could be turning down from here for a larger degree wave C. So Meta is very interesting. We've had wave 1, a very shallow wave 2, and wave 3 at the 1.38 extension of wave 1. Now it's turning down for wave 4. And it technically is into this region where wave 4 could complete already. I think it could test 610 to just consolidate. Because wave 2 was quite shallow, it could move down to 610 or even 600 for a slightly steeper wave 4. But after that, I do expect us to move past this 665 level and move towards 700. Microsoft, being very bullish, is actually not only just held on to the gap up from earnings. We actually tapped the 176% extension of wave 1, which is a very bullish wave 3, now turning down for wave 4, I think. So it's still quite early to say that it would definitely turn down wave 4 here. It could theoretically push towards 470, for example, the 200% extension. But given where we are now, so we are just at the level of December high, where people naturally would start taking profit. So I do think there's a greater chance that we turn down here for wave 4, and wave 4 could really be 415 to 430 level here before we get a higher high in wave 5. And I did think this was a C wave. All of this was a C wave in 5 waves, which actually gave me quite a bit of confidence that when Microsoft moved up after the April 7th, I did think this was wave 1, wave 2. I didn't really expect a new low, and now we're moving nicely in wave 3. So Microsoft has been moving very much against our own expectation all the way back in early to mid-April. NVDA has been pretty bullish so far, and we're about 14%, maybe 15% from the all-time high. So still a bit of work to do, and I don't expect us to get there in one go. But most of the hard work is done. So all of this accumulation, if you look at the volume, all of this was accumulation down here. Even though people were still very bearish below the 200-day moving average, and now we're decisively above it. This rally, I deem it as wave 3 of this large degree, wave 3, and it's been very bullish. I think we can get a retrace here for the small degree wave 4 in bracket here, and that could really end anywhere to 124 to 129. So it's just the beginning level here. There's not that much volume trading in this level, so I think it could drop all the way down to maybe 124. But ultimately, the broader direction is bullish one, and I do expect NVIDIA to make a new all-time high this year. SOXX has been quite a tricky chart to decipher because this wave 1 was quite short actually, and we've had a quite steep drawdown in this wave 4 where we have the ABC correction, and we have a V-shaped rally. As you can see, once we got past the 170 level, there was very little volume in this region, in this price region. We essentially shot straight up into this more heavily traded area of 210 plus. So here, I do think we have a bit of a resistance. First, we have this trend line resistance from the July 2024 high, and we have a huge volume here that was building from July 2024 to today, essentially. And during this consolidation, a lot of people were probably buying the dip and thinking this trend will uphold and we'll get a new high, but they didn't. They got trapped. Obviously, we had a V-shaped crash, and now we're back. So some people could be thinking, looking at the resistance, looking at the volume, looking at the P&L, they could be reducing the risk here just to scale back because they had been burnt from this move down. But overall, if you just zoom out in terms of technicals, we can see this is a massive bull flag, a bull triangle, and once it breaks out, we should see SOXX moving all the way to 350 plus. And this 350 plus is derived from the 138% extension, inverse extension of wave 4. Finally, PLTR calendar, very fun to look at because it defies gravity. It trades at insane valuations. There's always debate on whether the stock is overly expensive, and actually most people don't really know what the company does. Actually, we've made a new all-time high this week. What I see is that we have, this still is a B wave. What I mean is that this B wave is higher than the start of this drawdown in wave A, and that is an expanded flat. Typically, wave B is slightly higher than the beginning of wave A over here, and wave C will be lower than wave A. So it's an expanded flat, and ultimately, I'm expecting another drawdown here into wave C and maybe into the 60s, and then a higher high in wave 5. But just looking at the technical levels in front of us, I don't feel that wave C is quite completed yet, even though we've made a new all-time high. PLTR still traveling nicely within this band. It hasn't broken down to suggest that this has topped yet. And wave C is typically 100% plus extension of wave A, and we're not quite there. We reached the 90% or almost maybe 95% extension, but not 100%. Of course, in practice, the market doesn't really is not confined to the exact percentage rules all the time. The exceptions, and we're quite close. But I would just say it may be a little bit preemptive to call this a top for now. So I'm just going to be watching to see if we can just move over 137. So that's it for today. Thank you for watching.